Okay, let's unpack this. Welcome to the deep dive. Today we're plunging into Blink Charging, ticker BLNK. This is a company right in the eye of that, well, pretty volatile EV infrastructure storm.
Absolutely. And our sources today, they're from an intensive value investors deep dive. It really forces us to look at Blink through those core Warren Buffett principles.
And the history here is just, wow, dramatic. This stock, remember, it soared above $49 a share back in early 2021. Everyone was excited about electrification.
Seems like a lifetime ago, doesn't it?
It really does.
Yeah.
Today, September 26, 2025, it's trading around $1.52. That's a gut-wrenching 96% drop in value.
96%.
So the big question, the one we have to tackle for you today, is this. Is this the ultimate bargain? You know, the classic buy when there's blood in the streets.
Or is it just a catastrophic value trap heading towards zero?
Exactly. And we'll tease the conclusion right here. The financial reality we're about to dig into suggests this company has, get this, less than 6 months of operational runway.
Less than 6 months, based on their current cash burn rate, unless they secure new funding. Urgently.
It's a stark picture.
It is. And what's fascinating, is the EV charging sector has this really powerful narrative, this sort of noble mission, climate change, electrification. It pulls people in.
Makes you want to believe in the story.
Precisely.
Yeah.
People want to invest based on that story. So our mission today is to look past that compelling narrative and really dissect the actual economic engine underneath.
We need to figure out what intrinsic value, if any, an investor is actually getting.
Right. By scrutinizing Blink through those 4 tenets, understanding the business, competitive advantage, management evaluation, and that crucial margin of safety.
All right, let's jump in.
Okay. We begin with Chapter 1, business understanding, more than just a plug.
So Blink positions itself as this leading owner, operator, provider of EV charging gear and services. They boast a big footprint, over 90,000 chargers, 25 countries. But the origin story, that's quite telling, isn't it?
Oh, absolutely.
Yeah.
It's incredibly telling. They didn't spring from some, groundbreaking tech innovation.
Yeah.
Blink wasn't born from invention. It was basically born from bankruptcy.
Yeah.
The company we see now acquired the Blink network from a defunct player, Ecotality, back in 2013.
Right. Ecotality.
Yeah. And this suggests, a history of maybe acquiring discounted assets rather than pure organic growth driven by a superior product.
And their operational model, it's flexible, which sounds good for making deals, but it really complicates the path to profit, doesn't it? They have these 4 models, but they kind of boil down to 2 main financial approaches.
That's a good way to put it. You've got the high capital intensity versus the capital light models. Let me clarify that.
Please do.
Okay, so their Blink-owned turnkey model, that's the capital-heavy one. Blink pays for everything, the hardware, the install, the upkeep, and in return, they keep most of the revenue. It's high risk, definitely, but also the highest potential return. Think of it like, owning the whole hotel building.
Got it. And the capital light version.
That's the host-owned model. Here, the property owner buys the charger, installs it, keeps all the money from people charging up.
Okay.
Blink, in this scenario, is just providing the network connection, the software support. Basically collecting predictable, high-margin network fees. They're selling the booking system, not owning the hotel itself.
That distinction is really key because it highlights this strategic pivot they're trying to make towards recurring service revenue.
Exactly. And that part is growing strongly. Up 46% year over year in Q2 2025, hit $34.8 million in 2024. Looks promising on the surface.
But there's always a but, isn't there?
There is. That growth is getting completely overshadowed by a really sharp decline in their product sales. Those were down, 38.5% in Q2 2025?
Ouch.
Yeah. So this sets up a really high-stakes race against time. Can those service fees, those high-margin fees, scale up fast enough to cover the massive operating costs, especially before the crashing hardware sales and the cash burn just, run the tank empty?
That timing is critical. Which brings us right to the next big challenge for them. Let's move on. Chapter 2. The search for an economic moat.
Right. The EV charging space is, fiercely competitive. You've got established players like ChargePoint, EVgo,
And the big one looming.
and the huge shadow of Tesla's supercharger network. Especially now, it's becoming more interoperable. So when we look at Blink through that lens of traditional economic moats, the defenses look pretty thin. Alarmingly thin, actually.
Yeah, I was surprised reading about how weak the network effect actually is here. Usually that's a big advantage. It locks customers in. Why isn't it working for Blink?
It's really down to the industry embracing open standards, things like OCPP 2.0.1 compliance.
Okay.
And these necessary roaming partnerships like Hubject. It basically means that network advantage is crumbling. If you, the driver, can just use any app to access a Blink charger.
Then there's no loyalty.
Exactly. Your loyalty to Blink specifically just evaporates. You use what's convenient and what works.
And switching costs. Low. Zero for the driver, like you said. Use whatever plugs nearby. And for the property owner who installs the charger, swapping out hardware isn't that big a deal.
Manageable, yeah.
But hang on, what about scale? They're making deals, right? The sources mentioned partnerships with the U.S. Postal Service, Britain's NHS.
Yeah.
That's big. Surely that land grab, just being there, has some value, even if it's not profitable now.
It has potential value, certainly, in terms of future opportunity. But it's not an economic moat yet because it isn't profitable. And crucially, there are just no apparent cost advantages.
Right.
Blink's history is one of consistently negative operating margins. That points to a high-cost structure, not some lean, efficient operation.
So the strategy is basically...
It's a capital-intensive land grab, like you said, but it's funded entirely by external capital markets, not by profits from a well-defended fortress.
Which means...
It means the ultimate winners in this, well, war of attrition will be the companies with the deepest pockets, the strongest balance sheets, who can last the longest.
And that idea of funding growth with external money, that brings us right to the management's role. Yeah. Let's move to Chapter 3, evaluating management's track record.
Yeah, this is critical. We've seen leadership changes. Michael Battaglia took over as CEO recently. The team seems built for growth, for M&A, and probably most importantly, for raising capital.
Constantly raising capital.
Constantly. But the primary job of management is to allocate that capital effectively. And this is where the track record gets, well, pretty alarming.
Since the company's never made money, never generated positive free cash flow, they've funded every single acquisition, all their growth, through external capital. So what does that actually mean for you, the investor listening?
It means one thing, fundamentally. Massive shareholder dilution.
Explain dilution quickly.
Sure. Dilution happens when a company keeps issuing new shares of stock. Each new share reduces your percentage ownership of the company.
And Blink's number?
Blink's share count has exploded. It's up an extraordinary 21.23% in just 1 year.
Wow. Over a fifth more shares flooding the market.
Exactly. This is the polar opposite of creating value for each share you own.
It's just immense value destruction. And the numbers back this up starkly. I really want to emphasize this. Blink's return on invested capital, ROIC, that's how well they use the money they raise.
It's a key metric.
It's deeply negative, negative 26.28%. And compare that to their weighted average cost of capital, their WACC, which is 16.83%. Can you break down what those two numbers together tell us?
Sure. It's the brutal math of value destruction, plain and simple. The company is earning negative 26% returns on its investments.
Losing money on what it spends.
Right. While the cost of getting that money, the capital they raised, is nearly 17%.
So for every dollar they invest.
They're essentially lighting about 43 cents on fire, considering the cost and the return. The synthesis is just unavoidable. The company earns returns nowhere near its cost of capital. It is actively destroying value, not creating it every single time it grows using that capital.
And management's recent talk about cost cutting.
That $8 million annualized reduction, it looks reactive, frankly. It coincides with the stock price collapsing. It suggests a team scrambling for survival, not one proactively building a profitable, sustainable business from the start.
Okay, so the story they tell about the electric future is one thing. The story the numbers tell is quite another. We've got a strategy that seems flawed, management diluting shareholders relentlessly. Let's dig into the cash flow situation now.
All right, let's proceed to Chapter 4, a hard look at the financials.
The top line, revenue growth, it's not just stalled, it's actually reversed. Fell from $141 million in 2023 down to €126.2 million in 2024.
Not the direction you want to see.
Not at all. And the losses, they're just outpacing sales dramatically. The trailing 12-month net loss right now is minus $213.57 million.
A huge number. And the margin reality that flows from that is just staggering. The net profit margin is netigish 203.81%.
But that sink in, minus 203%.
Yeah, think about that. For every single dollar in sales Blink generates, it loses more than $2. How is that sustainable?
It isn't. Mathematically impossible long term.
Exactly. And this flows directly into the free cash flow, or FCF. That's the actual cash the business generates, or in this case, consumes after all expenses.
And Blink's FCF.
Consistently negative. The TTM FCF, the cash consumed in the last year, is minus $53.53 million.
Okay, minus $63 million burned in a year. That FCF figure is the absolute key metric here, isn't it? This is where that runway calculation gets really sharp.
It's crunch time, basically. Looking at their balance sheet, end of Q2 2025, the company reported having $25.32 million in cash.
$25 million in cash, burning $53 million a year. What does that simple math tell us about survival?
The math is unforgiving. You divide that $25.32 million cash pile by the burn rate, which is roughly $4.5 million per month.
Okay.
And the result is stark. The company has less than 6 months of operational runway left, unless they find new funding fast.
And this isn't just our analysis, right?
No, not at all. This situation was so dire, management themselves had to explicitly state in their August 2025 filing that there was, and I quote, substantial doubt about the company's ability to continue as a going concern.
Wow. When management says that in an official filing.
It's about as serious a red flag as you can get.
Okay, even with these terrible financials, let's look bigger picture for a moment. Chapter 5, the long-term view. Industry tailwinds and headwinds.
Right, because the underlying trend is undeniable. The shift to EVs, that's a massive tailwind. The U.S. market's projected CAGR is, what, over 30% through 2030?
Huge growth potential in the market itself. And government policy is supportive too. The IRA, the NEVA funding.
NEVE being the National Electric Vehicle Infrastructure Program, that's pumping billions into building out charging networks. It's a huge potential lifeline for companies like Blink.
But lifelines can be cut. What are the threats here? The headwinds?
Well, there are several big ones. First, the economy. High interest rates make financing harder and more expensive, both for Blink and for consumers buying EVs.
Makes sense.
Second, that government support. It creates huge political and regulatory risk. Those subsidies are critical. A change in administration could see NEV funding slashed, consumer tax credits repealed.
Which could seriously slam the brakes on EV adoption rates.
Absolutely. And third, you have structural, sort of practical barriers. Building out charging is expensive upfront. Grid capacity is often lacking, needing costly upgrades.
And the reliability issue.
And the widely reported problems with broken, unreliable chargers. That doesn't just hurt one company, it damages public perception for the entire industry and potentially puts people off buying EVs in the first place.
Okay, so huge tailwinds, but also really significant headwinds and risks. This makes valuing the company incredibly difficult.
Exactly. Which takes us to Chapter 6, the challenge of intrinsic value.
Right. With earnings and cash flow deeply negative, your standard metrics, price to earnings, price to free cash flow, they're meaningless. They just don't compute.
Useless in this situation. And trying to do a discounted cash flow, a DCF analysis, that would be pure guesswork, complete speculation based on future hopes, not present reality.
So we're left looking at relative metrics, comparing Blink to others or to its own assets.
And even there, the valuation looks, well, aggressive, to put it mildly. Blink's price-to-sales ratio, PS, is 1.48.
How does that compare?
It's actually higher than the sector median, which is around 0.95. So investors are paying a premium price for every dollar of sales.
Sales that result in massive losses.
Precisely. Paying a premium for unprofitable sales, it just doesn't make sense, especially in a business this capital intensive.
And the other key relative metric, price to book.
Price to book, or PB, is 2.21. That means the market values the company at more than twice the accounting value of its assets.
Okay, explain why that's particularly strange given Blink's performance.
Well, you're valuing the assets on the books at more than double their cost, even though the company's return on equity, ROE, the return it generates using those assets, is a catastrophic minus 122.34%.
Minus 122% ROE.
Yes, you are paying a huge premium, more than double book value, for a business that is actively, consistently destroying its equity base every single quarter. It's fundamentally irrational from a value perspective.
Okay, it's time to pull it all together. Chapter 7, the final verdict and the margin of safety. Let's run down that Buffett checklist again based on what we've found.
All right. Understanding the business, yes, but the model is challenged. Economic moat, failure. We found no durable competitive advantage.
Management rationality. Big failure there, given the relentless value destruction through dilution and negative returns on investment.
Absolutely. And finally, price attraction. Also a clear failure. The valuation is demanding, not cheap, despite the terrible performance.
So when we talk about margin of safety,
There isn't one. I'd argue there's a margin of danger here. The stock price, around $1.52, is more than double the company's book value per share, which sits around 69 cents.
So you're paying $1.52 for about 69 cents worth of book assets.
Assets that are being used to generate massive losses, you're paying a significant premium for an operation that consumes cash and destroys value. There's absolutely no safety net at this price.
So the final conclusion seems pretty clear. Blink charging isn't really an investment in the traditional sense. It's a story stock.
Exactly. A quintessential example of a business that probably belongs in Buffett's too hard pile, or maybe even the don't touch pile.
It's a high-risk speculation, driven purely by the narrative, the hope of the electric future, not by any sustainable financial fundamentals we can see today.
And the market seems to agree, at least partly, that high short interest over 17%, that's a lot of professional investors betting the price will fall further. It underscores just how dire the financial predicament looks to many observers.
Okay. Before we wrap up, what's the final provocative thought you want to leave our listeners with?
I think it's this. Even if the whole EV industry booms, even if charging demand explodes, Blink's chronic dependency on constantly raising more money means its ability to actually create per-share value for you, the owner, is severely limited by that relentless dilution.
So the network could grow, but your slice of the pie keeps shrinking.
Precisely. They can grow the network without actually growing shareholder wealth. That's a critical distinction.
A really important point. Thank you for joining this deep dive into Blink charging. And maybe a final thought for you to consider. Given that the company's operating assets consistently destroy value, when does the market finally decide that the sum of the company's parts, the chargers, the contracts, might be worth more broken up than the whole ongoing operation? Something to ponder.
Definitely. And hey, like and subscribe to Stock Analytic AI. Remember, for $4.99 a month, members get priority deep dives on specific tickers. We are covering all of the S&P 500 stocks over the next few months, and members get that exclusive priority access.
And if you just want a one-off deep dive on a stock you're interested in, you can always drop us a super thanks.
As always, this deep dive was built on sources curated for a single user. The research, the synthesis, it was accelerated using advanced AI tools. But
you absolutely must do your own due diligence. This is not investment advice. Thanks for tuning in.